In the world of personal finance, building credit and managing debt are two essential concepts that many people often confuse or use interchangeably. While both relate to how you handle borrowed money, they serve distinct purposes and require very different strategies. Building credit is about demonstrating your ability to handle financial responsibility over time, often to improve your borrowing power, while managing debt is about keeping the money you owe under control to avoid financial strain. Understanding the difference between the two is crucial for achieving financial wellness, as each affects your credit score, interest rates, future opportunities, and even your mental peace. This video explores the top 10 key differences between building credit and managing debt, helping you navigate them both with clarity and confidence. 1. Purpose and financial goal. The primary purpose of building credit is to establish or improve your creditworthiness, making you a more attractive candidate for loans, mortgages, and other forms of credit in the future. It's essentially a long-term investment in your financial reputation. On the other hand, managing debt is focused on maintaining financial stability by ensuring that what you owe doesn't spiral out of control. While building credit is about proving financial trustworthiness, managing debt is about preventing financial collapse and protecting your cash flow. 2. Focus on borrowing versus repayment. Building credit usually involves borrowing small amounts responsibly and repaying them on time to establish a positive track record. It's proactive and deliberate, often beginning with tools like credit builder loans or secured credit cards. Managing debt, by contrast, is reactive. It focuses on handling existing obligations, sometimes large and accumulated, through budgeting, consolidation, negotiation, or refinancing. In other words, credit building is about starting wisely, while debt management is about fixing or maintaining what already exists. 3. Impact on credit score. Both credit building and debt management affect your credit score, but in different ways. Building credit has a positive impact over time by showing responsible use of credit, such as low credit utilization and timely payments. Managing debt, especially if it involves reducing high balances or paying off loans, also helps, but often it's about mitigating damage from overuse or late payments. One builds your credit profile, while the other may aim to repair or preserve it. 4. Associated tools and strategies. When you're building credit, you might use tools like secured credit cards, authorized user status, or credit builder loans. These tools are specifically designed to report positive behavior to credit bureaus. Managing debt, however, involves using strategies like debt snowball, debt avalanche, consolidation loans, or balance transfers. The difference lies in the tools. One set is designed to establish a history, while the other is focused on controlling damage or reducing burdens. 5. Risk and reward dynamics. Building credit involves low to moderate risk but has the potential for high long-term reward in the form of better financial opportunities, such as lower interest rates and higher loan approvals. Managing debt, meanwhile, often carries higher immediate financial stress and limited short-term reward because the focus is on reducing existing liabilities. In essence, credit building is planting seeds for future success, whereas debt management is pulling weeds to prevent ruin. 6. Behavioral and psychological impacts. The psychological experience of building credit tends to be more empowering. It's future-focused and often involves watching your score grow over time. Managing debt, in contrast, can be emotionally draining, associated with guilt, stress, and urgency. While building credit can create feelings of achievement and confidence, debt management can trigger anxiety and fear, especially if you're behind on payments. Understanding the emotional dynamics of each can help in developing healthy financial habits. 7. Financial education and mindset required. Building credit requires a mindset focused on responsibility and patience. You have to understand credit utilization, interest rates, and payment history, and apply this knowledge consistently. Managing debt requires a mindset of discipline, budgeting, and often sacrifice. It also demands a realistic assessment of your financial habits and may involve lifestyle changes. The educational curve is different. Credit building is about system mastery, while debt management is about behavior correction. 8. Timing and life stage relevance. Building credit is often most relevant for younger individuals or those starting fresh, like students, recent graduates, or immigrants, who need to establish creditworthiness. Managing debt becomes more relevant in later stages of life, especially when people accumulate mortgages, auto loans, student loans, or credit card debt. However, both processes can overlap at any stage depending on financial behavior. Recognizing where you are in life can help prioritize which strategy to focus on. 9. Use of credit versus avoidance of it. Building credit requires you to actively use credit in a healthy way. You must borrow and repay responsibly to demonstrate your creditworthiness. Conversely, managing debt often involves limiting further borrowing, closing unnecessary accounts, or freezing credit activity to avoid worsening your financial situation. While one encourages selective borrowing to strengthen your profile, the other may require pulling back entirely to stabilize your finances. 10. End result and long-term impact. The ultimate goal of building credit is to achieve financial leverage, access to better loan terms, higher credit limits, and enhanced trust from lenders. Managing debt aims for financial relief, improved cash flow, and peace of mind by reducing what you owe. While both contribute to financial health, their end results are different. One is about upward mobility, and the other is about regaining control and stability. Knowing your goal helps you choose the right path or balance the two efforts. Building credit and managing debt are both pillars of a strong financial foundation, but they require very different approaches, tools, and mindsets. Where credit building is about forward momentum and future opportunity, debt management is about repair and sustainability. Many individuals will need to master both at different points in their lives, but confusing the two or focusing solely on one can lead to poor financial outcomes. By understanding the top 10 key differences between these two concepts, you can design a smarter, more intentional financial strategy. Whether you're trying to climb the credit ladder or dig out from debt, clarity is your greatest ally. And the more you align your actions with your long-term financial goals, the better prepared you'll be to achieve true financial well-being.